Hello everyone, welcome to my channel. My name is Orlando, and today we're talking about what do I use to break down deals, to figure out if it's a good deal or not, right? So I want to share with you the property analyzer that I use, guys, that I use to break down my 1 to 4 unit deals to figure out if it's even a good deal, what the cash flow is going to be, what are the benefits that I'm going to get out of that. So I'm going to put the link to the Excel spreadsheet that I use in my description. And so if you want to download it and have it for your own, you can do that. But let's just go over everything so you know exactly how to use it. Okay, guys, so we want to start with property information. Okay, so right here it says property name, location, type of property, size of property. All of this stuff is just cosmetic stuff. So it will allow you to identify the property, but it does not change anything when it comes to analyzing the property, okay? So we're gonna start there. So it just really allows you to, when you come back, you know exactly what you're looking at, especially if you have multi-properties that you're trying to analyze. That's what's that for. So let's just move into the meat of it. It's this cost information. Okay, so the building cost and the land cost. Why is this so important? Well, the reason why is land cannot be depreciated. The building costs can be depreciated. That is the reason why. But let's just make this easy. And the way that I do it as far as analyzing a deal right off the bat is I don't worry about splitting up the land cost and the building cost. I go ahead and just focus on the building cost, and I just put the full total purchase price. Went ahead and put something in here at $200,000. That would be the purchase price. And then we want to go into the less mortgage. Now remember, guys, everything in green you fill in. Everything in yellow, it will automatically populate. So right here, the next thing we do is less mortgage, and this is your down payment minus once again, your down payment minus what the purchase price is. So I'm putting down $10,000 on this particular example, and that means that the mortgage will be $190,000. We're going to go down to mortgage information, and we're going to go the interest rate. Whatever your interest rate is, or whatever interest rate you think you will be able to get, you want to put that here. I always go a little bit higher than what the actual mortgage rates are. So I'm going to put 5% here. And then let's say the loan term is based off of you living in the property. You're going to do a house hack. So I'm going to put that at a 30-year amortization, or that will be actually the term also. Okay, so then we go into the meat of the deal here. So it says potential rent, but I don't want you guys to look at potential rent. We're gonna focus on what the actual rents are. We don't want to look and say, okay, in next year, the rents are gonna be this. No, you're underwriting the deal on what you're currently getting the rents for. So right now, let's just say this property is getting $20,000 annually. Now we're doing this annually, guys. This is all based annually. And then it says here, assume 2% vacancy. I'm not going to put anything there. This is just an example, but let's just say you always want to put vacancy. Always. And then it says other fees and charges. If you have any other income or anything, let's just say that you're charging for, I don't know, laundry mats or storage or garages or whatever you're charging extra. That's what you would put here for other income. And remember, this is based annually. Now we're going to move to operating expenses. Operating expenses, guys. This is big because you want to make sure that you are accurate. And in any case, you want to go a little bit over on the expenses, especially when it's changing hands from the seller to you. You can expect that some expenses will be higher than other, especially taxes. That is key. Taxes will be redone, and they will be done under the purchase price that you were purchasing at, not the purchase price that the seller bought it at. Okay, remember that. Let's just say property taxes are $6,000. Then we're gonna do property insurance at $2,000. Once again, you see here, personal property tax. I don't have that in my state. You may have that in your state, so you want to include that. Offsite management would be property management if you're going to do that. Payroll, expenses, workers' comp, repair and maintenance is a big one, is normal. So I put that at $3,000. Utilities, if you're paying for any utilities, you want to put that there. Accounting, occupancy permits and licenses and stuff like that. Advertising would be if you're going to run the property yourself. If you're doing property management, then property management will do that for you, and that's included in that cost that they're going to charge you monthly. And then supplies, lawn care, and then miscellaneous stuff. So right here, you can see I put $3,000 for repairs, and then I also put $500 for lawn care. So now we're in total operating expenses. Now, where am I getting the total operating expenses from? Okay, so if you add up all of these right here, you will end up getting this right here, the total amount, which is $11,500 in total expenses. That's what you're gonna get. And then it says that your net operating income is $8,500. Now, where does that number come? It is literally this number, meaning the total amount of expenses minus the amount of money that you have coming in yearly for that rental property. So this is $20,000 minus $11,500. Now that total amount, like I said, is $8,500, and that's what your net operating income is. That's before you take out any mortgages. That's what it is. It's important because you have to make sure that that number is big enough to cover all of your mortgages, or you are going to be losing money. So we look at this and it says less annual debt service. That's the total amount of money that you're going to be spending when it comes to the mortgage annually. And that number is $12,240. The parentheses are around it because it's a negative number. It's an expense. And if you subtract that from the $8,500 that you're going to be netting, you will be losing $3,740 a year doing this property. Now, does that make it worth it? Well, here's the thing. We're going to look at the add backs of the principal, the depreciation, and then the taxable net income loss. These are all tax stuff. I will tell you, looking at this stuff at this point of trying to analyze a deal is blah. You don't really need it at this moment. You want to focus on cash flow first. You need to be making some money in your pocket. That number is $100 a door at a minimum for me. That's the way I do it, $100 a door minimum. So that means when I go look at the top here, I see that my initial cash flow, I am negative 37%. That is what I'm making on my $10,000, negative 37%, guys. We don't want to be there. We don't want to be there. The cap rate, 4%. What does that mean? That means that that's how much money you're making all together as far as what you would have to make in other investments to make the amount of money that you're making now. So ignore that also when it comes to this example. That's a little bit more advanced. I would focus on these two, this right here. You want to see what your cash flow is immediately, and you want to also make sure right here that your cash flow coming in is at that $100 a door area. If you come to those two, you'll find out really fast if it's a great deal. So once again, guys, I hope that this has been valuable information. Download the Excel spreadsheet if you're interested in understanding how to evaluate the deal using this spreadsheet. If you have any questions, please drop them in the comment section. And I'm gonna need you to watch this next video. This next video will help you get into your first rental property, guys. And I'll see you guys in the next one. Thanks.